The life and death battles of global businesses, the fatal decisions, the risks taken.
It was a real threat for everyone.
Driven by innovation.
All I had was something that I knew was disruptive. It was viewed to be impossible.
Blinded by fear.
Let's ignore it, because we don't really know what to do with it.
Desperate times and desperate measures.
That was the day that I had to go.
Fateful consequences.
So my only question would have been why?
And the lessons learned.
The problem was they were wrong, and it costs everything.
In 1844, long before trading floors, automotive industries, and the glass towers we admire today, there was a small dry goods store in Montgomery, Alabama. Nothing too flashy or admirable. It didn't feel like the beginning of something great, how much less a financial empire. Inside this store were loads of cotton, fabric, and fresh soil from nearby farms. Behind the counter was a vibrant immigrant called Henry Lehman. This young man had traveled from Bavaria to America in hopes of living the American dream. He believed that America rewards hard work. Was he right? Well, he started off selling sugar, tools, cloth, and coffee. He had farmers come in and out of his store with tired faces. When farmers didn't have cash, he made a quick deal. He accepted cotton instead of money. This small decision changed his life forever. Now, cotton was king in the South. Its value was at an all-time high, and profits hit the roof. Henry realized that he didn't have just a store, but was trading a commodity the world wanted. A few years later, his brothers, Emmanuel and Mayer, joined him in this dream, leading to the official launch of Lehman Brothers in 1850. The three brothers were not bankers yet, nor were they rich, but they had a dream. Fast forward to when the brothers became investment bankers and helped companies raise money. Their love of investment banking began in 1906, when they partnered with Goldman Sachs on an IPO. Between 1906 and 1926, the company helped launch nearly 100 new stocks to market. They worked with big names like Studebaker, F.W. Woolworth, and Macy's, helping to raise the money they needed to expand and dominate their industries. Lehman Brothers connected investors with ideas and became part of the machinery that powered America's growth. And with every decade, they grew stronger. So strong that they survived the Great Depression, 2 world wars, the Vietnam War, and the Cold War, when many firms vanished. This survival built confidence that turned into pride. Like the Titanic, not even God could sink this company. By the late 20th century, Wall Street was changing, and Lehman Brothers, one of the world's largest investment banks, wanted to evolve with the times. This small cotton store was now chasing complex deals and global power. As for the numbers, it was everything. It was now time for Lehman Brothers to bet on the American dream. And this is where the story begins. Betting on the American dream. Fast forward to the early 2000s, when Lehman Brothers were already shaping history. After surviving wars, depressions, and market crashes, it stood tall on Wall Street, ambitious. Recall that American Express owned Lehman Brothers from 1984 to 1994. In 1994, American Express separated from its parent company and sold shares to the public. This move brought in over $3 billion in fresh capital for Lehman. The new ambition in this era was housing. Across America, homes were selling fast, and prices were rising. Banks were handing out mortgages to anyone who asked. If you had a job, you could get a house. In some cases, people who didn't have a job still managed to get one. Owning a home was the American dream, and Lehman Brothers saw something in that dream. Mortgage-backed securities. What if we invested in these loans? They asked. From there, they acquired several lenders. In 2003, they acquired BNC Mortgage, a subprime lender. These loans were given to people with weak credit. This means higher interest, higher profit, but of course, higher risk. Then came Aurora Loan Services, another big shot in the mortgage industry. Lehman was all in on housing investments. The idea of diving headfirst into this industry was brilliant. Just bundle thousands of loans, turn them into securities, and sell them to investors worldwide. Money flows in, and fees pile up. As long as housing prices keep rising, everything is safe. Investors, Wall Street, and Lehman Brothers smiled at the bank. Years later, profits climbed. Analysts praised the brothers for their strategy as stock prices continued to rise. While everyone looked forward to a brighter future, something brewed up inside. Many of these mortgages were risky, as some borrowers had low incomes. Some had rates scheduled to increase later, while others had little or no documentation. None of these mattered as long as housing prices were still rising. Lehman convinced itself that it was the master of the game. They went on to buy up a massive share of the real estate market, with a 2007 receipt for over $100 billion in mortgage-backed securities and other assets. The in-house team built models and trusted analysts for future projections. But then, growth has a way of blinding people to reality. The firm borrowed so much to amplify returns. It leaned deeper into the housing market than many of its competitors. The profits were too good to be true. And for a while, it remained like that until 2006. That year, cracks began to appear in the housing market. Some borrowers missed payments, and foreclosures rose. Well, it was nothing serious yet, because when you're standing on top of the world, it is hard to imagine the ground disappearing beneath you. The numbers on the screen quickly turned red, and the fall happened faster than anyone imagined. The same American dream that motivated Lehman's rise was back with a test. Was this dream built on solid ground or shaky soil? High stocks and the cracks in between. Early 2007 was still good for Lehman Brothers. They had become the fourth largest investment firm in the country. Life was good. Deals were flowing, and the stock price climbed to $86 per share, giving the company a market capitalization of nearly $60 billion. On paper, the firm was thriving. Executives boasted that the housing market was stable and risk was managed. They claimed to be prepared for any future change. They sold confidence, and investors believed them. After over 150 years in business, who wouldn't? By mid-2007, more homeowners were falling behind on their loans. Subprime mortgage companies began to fail, and housing prices stagnated. In some cities, prices began to fall. Who would have thought? Lehman's balance sheet was packed with mortgage-backed securities. They were complex bundles rated by credit agencies and sold as safe investments. At this time, safety was a myth. As defaults increased, investors asked more questions. Who was holding the riskiest pieces? What were these securities worth? Was Lehman Brothers exposed? Executives were too embarrassed to admit the truth. The firm insisted everything was fine. The market had become too volatile, and buyers were becoming cautious, making it harder to determine prices. Lehman Brothers borrowed heavily to grow during this period. Years ago, borrowing made profits bigger, but it also made losses heavier when the tables turned. In the summer of 2007, these tiny cracks widened. Hedge funds exposed to subprime loans reported massive losses. Rumors spread across trading floors, and voices became hushed. Lehman's stock started to slide, one after the other. Executives reassured the public again. They promised that everything was under control and pointed to their long history of resilience. But then, fear guided decisions from now on. Every new report of rising foreclosures reduced confidence. Investors began pulling back, and short sellers started circling. The stock was nothing close to healthy. Inside the firm, employers felt the shift. Risk managers held long meetings and argued so badly. At the time, Madeline Antoncic, a risk professional with the firm, warned that the company was too risky, but she was fired for speaking up. The executives would never admit danger because it would cause more panic. Outside Lehman Brothers, something bigger was happening. The credit markets were tightening, trust was fading, and banks became suspicious of one another's balance sheets. In the middle of this growing storm, Bear Stearns, a Wall Street giant, was about to collapse. And what happened next sent shivers down everyone's spine. The warning shot no one heard. The first warning shot was from Bear Stearns in the summer of 2007. Two Bear Stearns managed hedge funds had been heavily invested in subprime mortgage securities. For years, these securities offered strong returns, and investors were happy. Unfortunately, when the market shifted and defaults rose, the value of those securities crashed. Lenders demanded more collateral, and investors withdrew their money. The funds no longer met those demands. By July 2007, both hedge funds collapsed. Slowly, reality was setting in. The collapse sent shockwaves through the credit market, prompting banks to ask the right questions. If Bear Stearns' funds were crashing, who else was exposed? Lehman Brothers, of course. Still, managers stood their ground, insisting everything was fine. The credit crisis had begun in earnest. As you know, credit is built on confidence. Banks lend to people, assuming that everything is fine. But when doubt creeps in, lending slows down, and money stops flowing. This was the case in 2007, when money moved more slowly than usual. Interest rates between banks rose, and institutions demanded more substantial proof of safety. Lehman Brothers again boasted that it had diversified assets and was ready to weather the storm. While they boasted, the stock price continued to slide. Then came March 2008. Rumors began to spread that Bear Stearns was running out of cash, and clients were pulling funds. Within days, the firm collapsed. The Federal Reserve stepped in, and Bear Stearns was sold to JP Chase for a fraction of its former value. An 85-year-old Wall Street giant was gone in the blink of an eye. Lehman watched as Bear Stearns fell so fast. While this happened, analysts questioned the firm's extensive holdings in commercial real estate and mortgage assets. Lehman promised to reduce exposure to calm fears. Unfortunately, things did not get better. Not now, not in the near future. The credit crisis was slowly closing in on them. Unlike Bear Stearns, Lehman Brothers would not find a buyer quickly, as the plans to bounce back behind the scenes fell through. Bear Stearns had just collapsed. Who was next? The day Wall Street broke. By September 2008, Lehman Brothers had no lifeline left. Stocks plummeted by 77% in the first 7 days of that month. The company tried to boost market confidence through equity fundraising, but this move was far from reassuring. It was from one loss to another. First, it was a $4 billion loss in the third quarter of 2008, followed by another $5.6 billion loss in toxic asset write-downs. Confidence disappeared faster than anyone said Jack Robinson. Inside Lehman's headquarters in New York, the lights stayed on all night. Executives searched for a last-minute lifeline. They tried to sell parts of the companies, sought investors, and spoke with government officials. They wanted a way out by all means. Luckily, 2 potential buyers emerged. It was Bank of America and Barclays. Negotiations started, and the pressure was intense. If they reached a deal before markets opened on Monday, Lehman might survive. Well, there was a problem. The government would not guarantee Lehman's bad assets. Without government support, buyers would not move an inch. The risks were too huge, and the losses were uncertain. By Sunday night, the deals hit a brick wall. In the early hours of September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. After 158 years of running a legacy business, it was over. The news hit the airwaves like an earthquake. Employees walked out of the building carrying their entire lives in boxes. Generations of history ended in a single filing. Investors panicked. Stock markets globally plunged, and banks lost trust in one another. Credit froze because businesses could not borrow, and companies struggled to make payroll. Within weeks, giants like AIG required government bailouts. The Dow Jones Industrial Average suffered historic declines, and retirement accounts shrank. Millions of people lost their jobs, and millions of others lost their homes. This single filing triggered the 2008 financial crisis. Although Lehman Brothers' failure was not the only cause, it sparked the fire. With $619 billion in debt, Lehman Brothers became the largest corporate bankruptcy filing in U.S. history. Barclays and Nomura Holdings eventually acquired most of Lehman's investment banking and trading operations. Although failure is inevitable, Lehman Brothers shares a chunk of the blame. They bet heavily on a housing market that wasn't 100% guaranteed. They borrowed too much and trusted a model they thought was stable. The small Alabama store that grew into a global financial titan crashed before our very eyes. Lehman's story is a reminder of how quickly tables turn.